Hey guys, and welcome to another week ahead video. Now, this week we have an exciting week coming up for the US dollar. There's a couple of events that can really move the dollar this week. We have a bunch of Fed speakers coming out. Now, what they have to say this week will be much more important compared to last week, considering those very two bad ISM numbers that we saw last week. We also have US CPI coming up, and then we also have the highly anticipated US-China trade talks scheduled to continue this week. All three of these events can really move the dollar, so let's jump into the video and see how we can possibly trade and prepare for these events. Okay guys, now we're going to follow the same three-step analysis process we follow every week. Step 1 will be finding the baseline for the US dollar. Step 2 will be finding the baseline for the upcoming risk events. And then step 3, finding possible sentiment shifts that can create trading opportunities on the US dollar. Now, if we start with step 1, finding the baseline for the US dollar, our current bias for the US dollar remains neutral. Now, we saw during the previous FOMC meeting in September, the Fed did strike a more overall hawkish bias, more hawkish than expected, despite delivering on that expected 25 basis point rate cut. Now, interestingly though, the Fed's dot plot showed no further rate cuts were expected by the FOMC board members, and currently that remains at odds with the market's expectations for at least one more cut in 2019. Now, we also had Fed Chair Powell expressing their concerns regarding the current US-China trade war and how that will impact the US economy as a whole. And he stated on numerous occasions that the outcome of the trade spat will play a big role in their outlook of monetary policy. So that trade discussions coming up later this week will be very important for that reason. Now, last week we saw a bumpy ride in the US dollar with the release of two very important ISM growth metrics. We had the ISM manufacturing PMI as well as the ISM non-manufacturing PMI, which both of them came out with very big negative deviations. Now, we saw the US dollar actually supported in the build-up to that ISM manufacturing PMI, as the markets were expecting the data release to show a slight recovery in the manufacturing area. But obviously, we didn't see that. We saw the ISM manufacturing PMI drop to a 10-year low, and the ISM non-manufacturing, which is services, drop to a 3-year low. Now, following these moves, we saw the US dollar was pressured, especially since the probability of an October rate cut by the Fed shot up to above 90% from just 39% prior to those two releases. Now, we did see the US dollar get some reprieve on Friday following a non-farm payroll, which was just slightly below market expectations. We saw that headline number coming in at 136K versus an expectation of 145K. But the real reason for the US dollar strength came from the US unemployment rate, which fell to 3.5%, which was the lowest since December 1969. Now, our neutral bias currently on the US dollar means that any shifts we see, whether that is positive or negative, can create great trading opportunities for us on the US dollar in the short term. So now we're going to move on to the baseline for the upcoming risk events. Now, this week, which makes this week a little bit different than normal, is we don't have only one specific risk event that can move the dollar. We have quite a couple of them. Now, even though markets will no doubt be focused on that US CPI number that we have due this week, the market's attention will also be fixed on a number of Fed speakers that is scheduled to talk as well. And we also have that important trade talks scheduled between the US and China on the 10th and 11th of October this week. So let's quickly look at the baseline expectations for these specific events coming up. In terms of Fed speakers, the reason why the markets will be paying attention to the Fed speakers this week is following that bad data points that we saw with the ISM manufacturing and non-manufacturing last week. The markets will want to hear where the Fed members has changed their stance possibly or their tone regarding monetary policy based on those numbers. And we know that the Fed came out more hawkish than expected in the prior FOMC. But that was obviously before these bad numbers that we saw for the ISM metrics. So that'll be something very interesting for us to look at. Now, as our bias for the US dollar is neutral at the moment, any dovish or hawkish comments regarding rate cuts can be market moving. So we need to pay attention to those events. Then the second one is US CPI. Currently, headline CPI month over month is expected at 0.1% and the year-over-year number is expected at 1.7%. For the core metrics, CPI month over month, markets are expecting a lower print of 0.2% from a prior of 0.3%. And for the year-over-year numbers, markets are expecting that to remain unchanged at 2.4%. Now, price pressures has been gaining momentum in recent months. We've seen that being picked up by a number of analysts who mainly attribute the rise in prices to that increase in tariffs, that previous increase in tariffs that we saw. So that'll be very interesting for us to see how the market interprets the CPI numbers in line with those tariffs. Now, we know that lower than expected inflation was one of the main reasons the Fed gave for cutting interest rates earlier this year. So any big deviations in the CPI number can be market moving this week. And then the third event we'll be looking at is the US-China trade talks that's scheduled to continue on the 10th and 11th of October. Now, there's been so much back and forth discussions and comments and insults and tweets between the two sides. It's really impossible to say whether we will have any substantial progress made this week in terms of the trade talks. However, it's interesting to note that some market analysts has noted that the two sides have shown some reconciliatory attitudes towards each other in the latest 2 weeks. That it's obviously, in terms of where the economies are at the moment, it's in the interest of both sides to find a solution and to find one fast. Now, there are currently no expectations of a full trade deal to be reached this week, but recent optimism and positive gestures from both the US and China has led some analysts to think that an interim or smaller deal might be possible this week. So then step 3, let's look at possible sentiment shifts, and we'll start with the possible dovish shifts. Now, with our neutral bias on the US dollar, if we see any overly dovish comments from Fed members this week, that can create a negative sentiment on the US dollar, especially if we have hawkish members like Fed Rosengren coming out with a more dovish stance, which will be contrary to his normal hawkish stance about the economy. That can create some great trading opportunities. In terms of US CPI, if we have a very big negative deviation, that'll feed into the market's current fears that the US economy is slowing at a faster pace than previously thought, and that can obviously create a dovish shift on the US dollar as well. And the biggest conviction move in terms of a dovish shift will come from an announcement that the trade talks will not take place due to some disagreement, or if the trade talks just falls apart completely. A lesser shift can occur if the talks fall apart or show no sign of real progress, and the planned October and December tariffs just remain in place as is. Now, that can create a dovish shift, as markets will probably assume more easier policy will be required from the Fed as a result of no progress in that trade talks. But on the trade talks, guys, the details are critical. So don't just jump into any announcement blindly. Assess what the implications are of any announcement before you make your move. Now, in terms of a hawkish sentiment shift, currently we have a neutral bias on the US dollar. So any overly hawkish comments from Fed members this week can create a hawkish sentiment in the US dollar, especially if the Fed members decides to rather talk down the negative numbers that we saw coming from the ISM readings last week and decide to rather focus on the more positives in the economy, like we have seen some Fed members do recently. In terms of US CPI, if that disappoints with a very big positive deviation, that will throw a spanner in the works in the Fed's warnings about lower inflation, and it will take away that short-term need for easier policy due to higher inflation numbers. Now, the deviation will need to be really significant to cause a tradable hawkish shift in this data point. The biggest conviction move will come from the announcement of an interim deal between the US and China. But again, the details will be very critical. A lesser conviction reaction can occur if the US-China trade talks just result in another postponement of the October and December planned tariffs. That'll obviously be a positive. But if there's just another postponement and no real progress, then that'll be a lesser conviction move if we see that development. Now, as we mentioned above, don't just jump in on any announcement. Assess the details and how that changes the market's current expectations for the trade war and for the dollar going forward. Now, possible currency pairs we can consider for a dovish and hawkish shift. In the case of a dovish shift from on the US dollar this week, we can look to pair the US dollar against the yen or the Swiss, which remains fundamentally bullish due to their safe haven appeal and all the concerns about the trade war and about global growth. However, the trade talks and the impact that can have on the overall risk tone in the markets this week will be very important for us to assess. If we see a very positive risk tone at the time of the meeting, pairing the US dollar against something like the AUD or the CAD would be a better option, as both of them should perform well in a positive risk environment. In the case of a hawkish shift on the US dollar this week, we can look to pair the US against something like the euro or the pound, which both remains fundamentally bearish in our view. However, as mentioned above, if the risk sentiment is very positive at that time, the yen or Swiss will be better options, as the positive risk tone usually sees depreciation in the safe haven assets like your yen and your Swiss. Now, how we can actually trade this event. These events will be valid for trading phase 1 sentiment shift trades if we do get that clear sentiment shift. Now, if you're interested to learn how this phase 1 trades work, you can check out our news trading strategy playlist on our YouTube channel, where we post weekly examples of how these trades work and how they play out. Now, if we do get that phase 1 move from a sentiment shift, then we can also look for a possible phase 2 pullback of that initial move. Now, we post updates on these moves and how the sentiment shifts inside our tradable sentiment shifts reports. Now, that is generated inside the Forex Source terminal under the Market Insights tab. And you can see each day which sentiment shifts are in play and which ones are still valid for trading the phase 2 pullbacks. Now, you can also learn about how these setups work during our live trading and analysis sessions and webinars each day inside the Forex Source terminal. Guys, thanks for watching. And just before you guys go, we actually rebranded and redesigned our entire website, www.forexsource.co. Please go and check it out and let us know what you guys think. Until the next video, cheers.